Here's what's coming up on the program today. International Monetary Fund approves $3.5 billion loan for Ivory Coast. International Energy Agency says solar power due to overtake oil production investment for the first time. And Zimbabwe bids to be Africa's carbon credit trading center. Hello and welcome to Business Incorporated. I'm Willie Bung. Let's go straight to the markets. And first up, Africa, where equities were trading with negative sentiments at intraday. We see Nigeria's NGX down 0.07% to settle as 52,890 points. South Africa still same margin, 0.07% to at intraday, while South Africa was, as I mentioned earlier, it's dripping red at the NGX for them at the trading floor. Now, in Egypt, the EGX 30 fell by 0.1% at intraday, while Kenya closed Wednesday's session positive. Now, let's check in quickly with what's happening at the Nigerian exchange with Ambrose Omodian, Chief Research Officer, Invest Data Consulting. He's going to be giving us the facts and what's going on there. Good morning, good afternoon, Ambrose. What's happening at the NGX? What's driving the negative sentiments we're seeing at the moment?
Yeah, we're not surprised to see the market pulling back. No, markets have rallied for straight 4 days, and the see market correcting at the midday today. It's not surprising because the life of Conway that released their audited account was not too impressive in terms of their payout. Market is reacting to that number. And at the same time, also, what the outcome of MPC meeting yesterday, coupled with the GDP figure that were released to the market yesterday, analysts and investors are digesting these figures and the impact of the 50 basis point decision from the MPC, how it's going to play out on the economy, and also which sectors or industry will benefit from the decision of MPC meeting in terms of the 50 basis point rate hike. And also, the GDP figure also is revealing to investors the sector that drove that 2.31% growth in GDP, despite it's a slowdown compared to the previous one of 3.52 in the last quarter of 2022. But since now investors understand the sectors that are now driving our recovery or the recovery of the economy, they can now position on the strength of that. But that means that activities in that sector can also support the performance of those companies in that industry. That is why we see such macroeconomic data. It's not only to see whether it's a positive growth or not, but we need to see which sector contributes significantly to that growth. And you can also, from the figure that the non-oil sector did about 93.79% contribution to the growth we recorded. It tells you that our diversification in terms of the economy is also coming up gradually. That means the incoming government should do more in terms of diversification. We have seen the impact of just the telecom sector that just was listed recently on the exchange, how they have changed the history of the economy in terms of their contribution to our GDP. For me, it is time for us to expand more industries or more sectors so that they can contribute to the economy. Also, if you look at the oil sectors, people agree that it's an improvement there. People say it's still negative. But if you look at the negative of 4.21 compared to the negative of 26 point something in the first quarter 2022, and also 13.13 in the last quarter of 2022, it tells that the oil sector also is coming up gradually. That means the impact of the security that government is putting, trying to bring a holistic way of addressing the vandalism of pipeline in that region, also playing out. I believe that this is what is guiding investors. But naturally, because markets have been up for straight 4 days, and also the outcome of MPC meeting, this interpretation of the outcome, and people also taking profit from the rally. That's what we're seeing. For me, the market is still very strong because the market has positive disclosure or outlook for the incoming government. That means
I just want to know what's happening with the banking stocks at intraday. Are investors still eyeing the banking sector?
I like your question. Thank you for that. The banking sector for me, from the decision of CBN, the MPC meeting yesterday, automatically a pullback in banking sector will create more opportunity for investors. That's why you can see volume is still going on there. That's why most of them are adjusting up and down. People are telling us that because the adjustment in the rate will be a plus for the banking sector, even at the detriment of the economy. because the banking sector is the one that lend. Now, if lending rate is high, they benefit more from it. And also, you can see since May last year till date, the net of results are coming from banks. You can see improvement in their interest income. If another hike has happened yesterday, that is why investors understand that this service sector is also the one that contributed to the GDP. That is where they should be. That is why you can see more activities still there in the banking sector. And anytime, any day, in any economy, banking sector remains what the engine room of an economy. For that, people whether are investing with information and they are relaxing investing because they know activity will impact positively at the end of the day.
So what should we expect for the close? Should we expect the bull or the bear?
No, the market will end in the south. Market will end in the south because of overtaking activities. Yeah.
So negative close for the market today.
Yeah,
that's not a good one for some investors. That's not the news we want to hear, Ambrose. But thank you so much.
Market have been up for 4 days. It's part of the market.
We do need to bring home the bacon. Let the week close in the green. I just hope the 4 days will carry through and we'll see a green close at the end of the week.
It's possible. Thank you.
Thanks so much, Ambrose Omodian, Chief Research Officer, Invest Data Consulting, for those insights. It's always good to have you.
Thanks for having me. Yeah, cheers.
Now let's take a peek into the Middle East markets where stocks were trading negative at intraday. The Abu Dhabi was down 0.41%. Dubai was up, however, 0.14%. And elsewhere, still within the region, we see Saudi down 0.24% and Qatari index down 0.05%. Now, official figures are showing that Germany fell into a recession around the turn of the year. Now, Deutsche Welle's Emily Leshner joins us from Berlin to tell us more. What the data, tells us about that. Emily, what does the data tell us?
Thanks for having me. Reports today are telling us that Germany's gross domestic product fell 0.3% last quarter, and it had already fallen 0.5% in the fourth quarter of 2022. So 2 consecutive negative quarters means that Germany has technically entered a recession at the beginning of this year. Initially, the expectation was that Germany wouldn't contract, that it would only experience 0% growth, but that wasn't the case. However, it's not entirely surprising to many economists, like Clemens Fuest of Germany's IFO Institute for Economic Research. He said that their latest survey suggested that business managers have a pretty pessimistic outlook right now, particularly in trade and manufacturing. They're struggling with weak orders and inflation. And the overall outlook for the economy for the rest of 2023 is pretty somber. The IMF says it expects economic growth to hover around stagnation. And that's certainly a disappointment to German lawmakers who were feeling optimistic this year. They had raised their forecast for economic growth to 0.4%.
What contributed to this, Emily?
Well, inflation has played a big role. In April, the annual inflation rate was 7.2%. Inflation eats away at purchasing power, and we saw this reflected in household consumption in Germany, which was down around 1.2%. People spent less on food, drink, clothing, and furniture during the first quarter. Things could have been worse, though. After all, Russia's war in Ukraine has led to an energy crisis over the past year. Germany was long relying on Russian gas, and had the winter in Europe not been unusually mild, a gas crisis would have had a much stronger impact in the economy. And there are other factors that helped keep the GDP up, too. For example, exports and investments made in construction and equipment like machines, devices, and vehicles.
So what will the markets be watching today with all that is going on?
Markets are going to be watching to see how the European Central Bank manages the situation. They've had to increase interest rates in order to combat inflation, but inflation continues to rise. So they may have to find a different balance, a different approach, perhaps holding off on raising interest rates until the economy recovers.
Thanks so much, Emily Leshner, for that insight. We'll keep in track of what happens in Germany. Now move over to Asia, where Hong Kong's Hang Seng Index led losses in Asia on Thursday, falling about 2% to close at 18,746 points, the lowest level this year. Mainland Chinese markets also fell, with the Shanghai Composite down 0.11% to finish at 3,201 points. Now it's the lowest close in over 4 months. Asia-Pacific markets were largely lower amid lingering concerns over the U.S. debt ceiling negotiations that's ongoing, and as the Bank of Korea held its benchmark interest rate steady for the third consecutive time. South Korea's Kospi shed 0.5% to end at 2,554 points, its first drop after closing flat on Wednesday and after a 7-day winning streak. Australia's ASX 200 declined 1.05% to end a record. That's a record fourth straight day of losses. The index also hit its lowest. It is lowest in about 2 months. And in Japan, the Nikkei 225 bucked the trend and rose 0.39% to end at 30,801 points. Now, in the U.S., Dow Jones futures slipped on Thursday after Fitch Ratings placed the United States AAA rating on a negative rating watch. Meanwhile, the Nasdaq 100 futures rallied after a strong earnings beat from Nvidia. Dow Jones Industrial Average futures fell 0.16%. Meanwhile, the Nasdaq 100 futures jumped 0.7% and S&P 500 futures gained 1.95%. Fitch Ratings put the U.S. AAA long-term foreign currency issuer default rating on a negative watch. The rating agency says the ongoing debt ceiling negotiations have raised the risk that the government could miss payments on some of its obligations. However, Fitch said it still expects a resolution before the ex-date. Now, oil prices fell early on Thursday after Russian Deputy Prime Minister Alexander Novak played down the prospect of further OPEC Plus production cuts at its meeting next week. Brent crude futures was down 0.5% to $77.95 a barrel. U.S. West Texas Intermediate crude WTI fell 0.7% to $73.83 a barrel. In the previous session, oil prices were supported by a warning from Saudi Arabia's energy minister that short sellers betting on oil prices will fall should watch out for pain, and some investors took that as a signal that the Organization of Petroleum Exporting Countries, OPEC, and including Russia together, could consider further output cuts at a meeting on June the 4th. Now, gold prices were little changed on Thursday as the dollar advanced to a more than 2-month high and sapped demand for the dollar price metal, while investors awaited developments in the drawn-out debt ceiling negotiations in Washington. Spot gold rose slightly to $1,961 per ounce. Gold futures fell 0.1%. Bullion has attempted to recover from its previous sell-off, but a stronger dollar and higher U.S. Treasury yields continue to limit the upside. Meanwhile, U.S. Treasury Secretary Janet Yellen on Wednesday maintained early June as a debt ceiling default deadline. Investors will also scan U.S. GDP estimates and initial jobless claims due today for guidance on the economy's health. Up next, updates from the commodities market space. Stay tuned. This is Business Incorporated. Welcome back. Now, the world's leading investment bank, Goldman Sachs, had made some bullish projections earlier for oil prices, forecasting prices to rise to as high as $200 per barrel. But the investment firm has recently reviewed oil prices downward to $95 per barrel to reflect market fundamentals. Victoria Momo, analyst with financial derivatives company, joins me to discuss this latest development. Good afternoon, Victoria. What does this mean for Nigeria, a country whose domestic need for oil is mostly met by imports?
Good afternoon. Thank you for having me. Like you rightly said, Goldman Sachs has been one of the investment firms that has a bullish outlook for oil prices and even commodity prices in general. And the factors that actually support their bullish outlook is actually undersupply of oil, OPEC, strong reliance on OPEC or strong compliance of OPEC supply cuts, as well as strong demand, expectation of strong demand from China. The current projection of oil prices to about $95 per barrel is actually, way higher than the price at which oil prices is currently trading. It's actually a good one for Nigeria, considering the fact that our budget benchmark is placed at $75 per barrel. However, we are still faced with high import bill, and this is because of the low oil production here in Nigeria, which has created the need for importation of oil into the country. So as a result of that, it has continued to dent our foreign exchange reserves and, mount pressure on, earnings here in the country. However, a bright spot is actually the Dangote refinery that is expected that has commenced, and it is expected that oil production would increase in the country, and this would, reduce the need for importation into the country, and as well promote earnings for the country in terms of export of the commodity.
Now, the projections by the investment firm are not only restricted to oil prices, but we also see other commodities like LNG and grains. What is the outlook for commodity prices? Is it the best bet for investors at the moment?
Well, actually, Goldman Sachs did not just have a bullish outlook for oil prices. There are also other commodities that the outlook are bullish, and one is LNG. And they expect that the current low prices of LNG would increase, this year. And this is as a result of a restocking, by investors, and as well as, increased demand for LNG from China in order for their industrial activities. Also, we have commodities. We also have commodities like, the grain prices, which of course are trading low now because of the extension of the Black Sea grain deal. There are commodities also like sugar, yes, that has been trading higher for a while now, and then is expected to continue rising as a result of tight supply in the market. And this is expected to continue. Most of these commodities are commodities that Nigeria imports into the country. And of course, the increase in importation of these commodities, as well as due to the while prices remain elevated, actually increase the country's import bill and also weigh on the country's foreign exchange reserves. But on the bright side, there are commodities like cocoa, which Nigeria exports. So the increase and prices for cocoa are projected to increase as major suppliers, that's Ivory Coast, actually recorded low rainfall. So increase in price of cocoa would actually boost the export earnings for Nigeria and support growth.
Now, we see the Nigerian government, you're talking about exports here, has resorted to an import substitution policy, which is geared primarily towards curtailing dependency on foreign products. And you've used a host of, policy tools like tariffs, bans, and quotas. But what we want to know, what opportunity does this present to the country, given the outlook for the commodity prices?
Well, the general outlook for commodity prices is that it would, tilt towards the high side, and it is true that Nigeria government has actually, placed import restrictions on certain commodities, and we've seen domestic industries actually taking advantage of this, by investing in most of all these commodities in order to increase, the domestic supply of the commodity. We've seen increase in investment in rice, increase in investment in sesame seeds, and all of that, and that all of that has actually, supported earnings for domestic industry. However, the rising or the prospect of increased price of global commodity actually presents opportunity for domestic investors to take advantage of that rising price to increase domestic production, and as well as produce more for exports in order to like I said, take advantage of the high prices at the global market. And the government can actually come in here by subsidizing the domestic prices of these commodities in order to boost the domestic demand for it. When prices are relatively cheaper compared to the ones that are being imported, people would substitute the domestic commodities for that of the international one. So the government can also, make the business operating environment, very, very favorable for the businesses in order to, make them competitive in the international space. So, that would, help the economy in general.
Thanks so much, Victoria. And I do hope you're taking positions in the non-oil commodities space. I don't know which one you've taken. Is it grain? Let me know. Thanks so much, Victoria Momo, analyst with Financial Derivatives Company, for sharing those insights. Now we'll move on to the other stories in Africa, where the International Monetary Fund, IMF, has approved a $3.5 billion loan agreement for Ivory Coast to help the country tackle financial challenges and assist with its economic transformation. In a statement, the IMF says getting the full loan will be dependent on the West African nation making structural changes to its economy, which is squeezed by a global downturn and the ripple effects of the war in Ukraine. The 40-month arrangement will help support the country's transformation towards upper middle income status over the medium term while preserving macroeconomic stability. Now, solar power spending is due to hit more than $1 billion a day, or around $380 billion on a yearly basis, outpacing investments on oil production for the first time in 2023, and that's according to the International Energy Agency, IEA. The IEA says about $2.8 trillion is set to be invested in energy worldwide in 2023, of which more than $1.7 trillion is expected to go to renewables, nuclear power, electric vehicles, and efficiency improvements. The rest, that's about $1 trillion, will go to oil, gas, and coal. Now, Zimbabwe is making a bid to become the carbon credit trading center for Africa. Zimbabwe's Victoria Falls Stock Exchange plans to set up trading in carbon credits by September, seeking to capitalize on sweeping changes on how production of the securities will be regulated in the country. The country aims to register projects generating the offsets on a carbon registry at its dollar-denominated Victoria Falls Stock Exchange, according to a pamphlet from the organizers of the state-backed conference, the Africa Voluntary Carbon Markets Forum, which is scheduled to hold July the 3rd to 9th. Now, the impact of climate change continues to dominate conversations in Africa, with the Africa Development Bank projecting Africa needs $2.7 trillion to tackle climate change crisis. According to Professor Kevin Urama, Chief Economist, AFDB, Africa already seen the effects of about 15% of the GDP, which is cutting through that, and countries must ramp up fulfilling pledges to lower global warming. He was a guest on our Business Morning program.
That is huge. As we estimated in our African Economic Outlook report of the year 2022, Africa is already losing 5 to 15% of its GDP per capita growth, gross domestic product per capita growth, because of the impacts of climate change. Changing weather events, floods, droughts, and other cyclones and other things are impacting several parts of the continent. Floods in Nigeria, for example, you will find a lot of damages to property, a lot of damages to lives and livelihoods that needs to be rebuilt with the limited fiscal space that these countries have. And you have different types of those challenges across the continent. And the frequency is also increasing. And as you know, Africa did not cause climate change. We have contributed only about 3% of the CO2 emissions that caused the climate change. But other countries have benefited in their own economic growth by actually emitting climate-forcing emissions that has created the problem. So because climate change is a global commons challenge, it then means that all actors involved need to come together to meet their commitments if we have to save the planet and keep the world going below the thresholds of temperature rises that is expected to become catastrophic for the world if we did not do that.
And that brings an end to our Business Incorporated program for today. Do join us tomorrow, same time, same station. It's Channels Television Live. I'm Will Ibang. It's bye for now.